All right, let's dive right into this explainer because today we are tracking some absolutely massive global shifts. We're talking about a scenario where the UK economy is poised to take a brutal £35 billion hit. Plus, we've got severe fallout from the Iran conflict, huge structural shakeups in global oil, and looming over all of it, a $10 trillion tech earnings block hitting tonight that could literally shift the entire market. There is a ton of complex data flying around right now, and it's super easy to get lost in the noise. But we're going to break it all down step by step so you know exactly what is driving these global markets today.
You can really think of the global economy right now as being caught in this high-stakes tug-of-war between three interconnected forces. First up, the macro shock. Oil's just surging past $111 a barrel, and that's triggering severe domestic growth downgrades across the board. Second is what I'd call the micro-reality. Traditional, old-school sectors are quietly delivering these incredible first-quarter cash beats. It turns out boring might just be better in a crisis, right? And third, we have this massive market imbalance, an immense $10 trillion concentration in the tech sector that is about to be heavily tested by real interest rates in tonight's earnings reports. These three pillars are going to guide our analysis today and show us exactly where things are heading.
So let's start with that first pillar, and honestly, a pretty sobering number, £35 billion. That is the heavy toll the British economy is projected to absorb over the next 2 years. This warning just came in overnight from the National Institute of Economic and Social Research, and man, they are ringing the alarm bells loud and clear. When an institution with that kind of weight projects a hit of this magnitude, it pretty much guarantees a very rocky, contracted road ahead for domestic growth. We're talking tighter corporate budgets, way less consumer spending, and a real, tangible squeeze on everyday economic activity. Now, this £35 billion hit isn't just some random economic hiccup. It's actually a direct four-step geopolitical chain reaction. It starts with the catalyst, reports that the US administration is preparing for an extended blockade of the Strait of Hormuz. That friction instantly creates a shockwave, spiking Brent crude to over $111 a barrel. And that intense energy spike, well, it flows directly into our domestic impact, that £35 billion toll we just talked about. Finally, all of this translates into our new macro reality. We're seeing UK GDP growth downgraded from 1.4% to a sluggish 0.9%. Inflation expected to top 4% again, and crucially, especially if you're dealing with mortgages or corporate debt, expected interest rates aren't falling anymore. They're now projected to peak at a stubborn 4%.
But wait, compounding this immediate energy shock is a historic, long-term structural shift. While that crazy vertical spike in oil prices is grabbing all the headlines today, there's a much deeper complication brewing just underneath the surface. The United Arab Emirates, which, remember, is the world's fourth largest oil exporter, is officially quitting the OPEC cartel amid this Iran conflict fallout. This is a monumental departure. Word is, the UAE plans to aggressively ramp up their own production once the strait reopens, completely breaking away from OPEC's tightly coordinated supply limits. So what does this actually mean? Well, even if the immediate conflict gets resolved tomorrow, the very architecture of global oil supply has been fundamentally fractured, and that could trigger entirely new layers of price volatility down the road.
Now, you might expect all this geopolitical chaos to just crush corporate profits across the board, right? But ironically, this volatile, high-rate environment is actually a goldmine for the old economy. Just look at these Q1 beats. UBS, Switzerland's biggest bank, absolutely smashed forecasts with a $3 billion profit jump. How? Just by capitalizing on record trading revenue from all this market turbulence. Then you have Lloyds beating estimates simply by riding the wave of higher interest rates, basically expanding the profit gap between what they charge borrowers for loans and what they pay out to savers. Throw in pharma stalwarts like AstraZeneca and GSK posting huge double-digit growth on cancer drugs and vaccines, and the picture becomes super clear. It's actually fascinating. While the flashy tech companies dominate our news feeds, in a genuinely chaotic world, it's the traditional quote-unquote boring sectors that are quietly printing hard cash today.
So this creates a really fascinating tale of two markets that is absolutely crucial to understand. On one side, we've got the old economy, which is built on cash and volatility. Like we just saw, banking and pharma are taking today's nasty macro headwinds, the high rates, the massive energy shocks, and turning them into concrete, realized profits right now. But on the exact opposite end of the spectrum is the new economy, built purely on capital and massive scale. We're talking about a highly concentrated tech block trading almost entirely on the future disruption of artificial intelligence. These guys aren't just selling what they did this quarter, they're selling promises of tomorrow. And honestly, that makes them highly vulnerable to some sudden harsh sentiment corrections if those lofty promises start looking even a little bit shaky.
Which brings us to the absolute main event on Wall Street tonight. After the closing bell, Alphabet, Amazon, Microsoft, and Meta are all reporting their earnings. Combined, these four companies carry an almost unimaginable market cap of $10 trillion. $10 trillion. To put that sheer power into perspective for a second, the Nasdaq recently hit record highs, actually up 10% since the outbreak of the conflict. And it's floating almost entirely on the AI investment narrative carried by these specific four giants. They are basically single-handedly propping up broader market sentiment right now. So, whatever numbers they drop tonight, and whatever forward guidance they give on their AI investments, it's going to dictate the trajectory of the entire global market for weeks to come.
But there are some major cracks starting to show in the foundation of that whole AI narrative. While the Nasdaq has been logging these historic closes, the vulnerability underneath is becoming super obvious. And the reality check? It's coming directly from OpenAI itself. US indices actually retreated yesterday after reports leaked that OpenAI missed both its user and revenue targets. And it gets worse. Executives have warned internally that the company might actually struggle to fund its massive computing contracts if revenue doesn't scale up quickly. Just let that sink in for a second. If the very engine driving this entire AI boom is struggling to pay its server bills, it raises some serious, immediate questions about the trillions of dollars of capital being poured into the sector. It's a stark reminder that future promises, well, they eventually require present-day cash flow.
Sitting squarely between the geopolitical chaos of the oil markets on one side and this high-stakes tech hype on the other is the US Federal Reserve. Today marks Jerome Powell's final meeting as Fed chair, and the market has already priced in 100% probability of a hold. The Fed is anchored in a definitive wait-and-see mode, and it's pretty easy to see why. They're essentially trapped, monitoring three extremely volatile metrics. You've got inflation spikes stemming from the Strait of Hormuz, the overall escalation of the conflict in the Middle East, and the big question of whether all this AI capital spending is actually translating into real economic growth or just dangerous market froth. With so many wild variables in play, making a definitive move on interest rates right now is literally a risk the Fed just cannot afford to take. All right, before we look at how the broader markets are pricing all of this in, here are 5 rapid-fire, under-the-radar developments echoing across the financial world today. We've already touched on the historic UAE departure from OPEC and OpenAI struggles with revenue. Now, on the personal finance front, the Barclays brothers have finally reached a settlement with creditors, narrowly avoiding personal insolvency after a really long legal saga. Meanwhile, the corporate side of Barclays is pulling back, cutting its shadow banking exposure, which, if you're not familiar, is essentially unregulated lending outside traditional banking rules after taking a really painful £228 million hit. And finally, environmental tensions continue to spill over into corporate governance, with NatWest's annual general meeting actually forced to adjourn today after some major disruptions from climate activists. So, bringing all these complex forces together, here is your final market snapshot. We're looking at an environment that is priced near historic peaks, but it is clearly holding its breath. US and UK equities, including the Dow, the S&P 500, Nasdaq, and the FTSE 100, they're all slightly in the red today, pulling back cautiously after their recent record highs. But the commodity sector, that is where the real fear and friction are living right now. Brent crude is sitting at a punishing $111.19 a barrel, and gold, the ultimate safe haven when the world gets chaotic, is hovering near all-time highs above $4,500 an ounce. The market is tense, it's elevated, and it is just waiting for that closing bell.
And that pretty much wraps up our explainer of today's market forces. We've tracked the massive £35 billion hit to the UK, the energy shocks tearing through OPEC, the solid, undeniable cash generation of the old economy, and the fragile promises of the new one. But with that $10 trillion tech block about to report their earnings in literally just a few hours, I want to leave you with a question, and I'd really love to hear your thoughts in the comments. With so much geopolitical volatility swirling around and just an astronomical amount of capital at stake, are you personally buying or selling into tonight's colossal tech earnings? Let us know down below. Keep learning, and I'll see you in the next explainer.